Today we're learning about the topic of risk management and specific steps you can take to help set your operation up for success. Joining me again on the show is Gene Copenhaver, who runs stocker cattle here in Southwest Virginia. Gene, can you tell us a little bit about your operation here?
Yes, our operation was originally started by my father and my uncle probably 60 or 70 years ago. And it has evolved from a general livestock where we had cattle, stocker, cow-calf, hogs, sheep, and burley tobacco. And now we're primarily a stocker operation the last 10 to 15 years. Our operation is grass-based. We buy cattle from a local buying station in local markets, and we keep those cattle until they're 9-weight cattle, and then they're shipped to a feedlot somewhere. This year, all steers. Most years steers and heifers, but this year we went with all steers, and it seemed to be what we can get and what we know better when we market our cattle.
So in that process of getting them in and getting them out, what opportunities do you explore along the way to help manage risk?
Well, we manage risk on the input side and the sales side output too. On the input side, we recently built a new commodity shed, and we're getting ready to build another commodity shed this summer to buy our feed where it's at its low point and the feed keeps well. We'll save up to $100 a ton on feed sometimes, and we don't feed a lot, but what we do, we save probably $10 or $15 a head just by doing that. And the commodity shed, we figure, will pay for itself in 2 to 5 years by doing that. On the other side, we tried everything on the output side. 40 years ago, we did straight hedging before there was anything as far as options. We've done options for a number of years, and I guess that has been our primary thing. We get forward cash contracts. We did those in 15 and 16 after 2014, after the market dropped, and 14 was options. We traded up our own options 3 different times during that year, and still had some room to trade up again. But we'll try anything. I guess the best thing has come around in the last 2 years, and we've started at this year, was Livestock Risk Protection. It's a great program. It's very similar to what we did with options and the puts, and we do things maybe a little bit different. We decide what our production costs are going to be and what our cost of cattle are, and then we try to protect for any disaster loss above a break-even price, and usually $100 to $200 above break-even. And with LRP, it's a lot better situation than the options. It's not as flexible. You can get in and out, but at the same time, you got every month where we have a June and July when we start selling. There's not a CME contract for those months in feeder cattle. The big thing, I guess, is subsidy. I was looking at one of our contracts, insurance contracts here in the last day or two, and the subsidy was over 50% of what we pay. So. And the other good part is we don't have to pay for it until the contract's due. The insurance contract is due, and before we had to put option money up before, and so that takes away from your cash flow. It adds extra interest if you're borrowing money. This year's it's LRP, and if they keep on tweaking the program and make more common sense things with the program, I think we'll stay with LRP for our risk protection on that side of it. For a number of years, between the hedging and the puts, we kind of sold on the same market, bought and sold on the same market. So we thought that was a form of risk protection when you're doing that, when you're buying your new animals and you're selling your new animals, so you're on the same market, so there's not as much volatility there as you would have.
Yeah. You really have tried a little bit of everything.
Yes.
Yeah. You talk about LRP. It is a new program. There have been some recent updates. How have those updates impacted you and your insurance program?
Well, if we get to collect off of it, we're going to collect it 30 days quicker. It looks like they're going from 60 days to 30 days. And the other they increased the number of animals that a person could have, and throughout the year, I think it went from 12,000 per cycle or 24,000 for the year, which that doesn't affect us. But I think that's all good. I think any time that you can manage, especially a disaster, we never pay full up. In fact, this year I think our cost per animal is $20 So to insure it fully, I think it was more like $50 to $60. We might look at it a little bit different. We're looking at for just the risk of a big loss or disaster, and that's all. And this year might have been different. We should have gone the other way, but 9 times out of 10, you're going to lose your money, whether it's a put or your insurance anyway. You're never going to collect. So.
You also have you're not only managing risk on your own operation, but you have a background in finances.
Yes.
Serving with Farm Credit, I believe, for a lot of years. So what would you tell your fellow cattle producers about risk management and strategies?
Well, I was with Farm Credit and I was with a commercial bank my last 18 years, but one thing we required as a lender was some type of risk management plan. And we couldn't tell them how to risk manage because of lender liability, but we always thought that they should have some type of plan and should be in the game somehow on managing the risk. And it's very important, especially if you're borrowing money, because if you're borrowing money and you don't have that money to pay back on that line or whatever product you have out there, then it could be a problem.
Yeah. Gene, thanks for your insights and thanks for playing host today for our show. Appreciate it.
No problem. Welcome to be in Southwest Virginia.
And don't forget that NCBA staff just right up the road in Washington, D.C. and out in Denver work every day to protect cattle producing families across the country. And you can help by becoming a member. Call 866-233-3872 or go to ncba.org.